Some of the biggest real estate fortunes were made during market corrections. Right now, Portsmouth is sending signals most investors are ignoring: rising vacancies, investors pulling back, and lenders tightening up. These aren't random shifts, they're signals. The same kind of signals that in 2008 separated those who capitalized from those who were caught off guard. So the question is this just a market dip or is the start of something much bigger? If you own, invest, or consider entering Portsmouth commercial real estate market, you need to know what's happening before the window closes. Portsmouth commercial real estate market is changing, and 5 major warning signs suggest a turbulent period ahead. First, vacancy rates are rising across office, retail, and some multifamily sectors. Office properties in particular are struggling due to permanent shifts toward hybrid and remote work from home models. Retail properties that lack strong anchor tenants are seeing foot traffic decline, and even some multifamily buildings are facing higher turnover rates as tenants relocate to search for better deals. Now, the expectation that demand will bounce back post-pandemic has not really materialized, forcing landlords to rethink their long-term strategies. Second, transaction volume has slowed as sellers refuse to adjust prices. Many property owners securing financing when interest rates were at record lows are now reluctant to sell at today's higher cap rates. This creates a standoff between buyers and sellers, leading to fewer deals getting done and capital sitting on the sidelines. The longer this persists, the more pressure will build for pricing adjustments, which could happen readily once distressed owners are forced to offload properties. Third, insurance costs are rising across the board. Flood risks, regulatory changes, and increased claims have led insurers to raise premiums for commercial properties. Investors who did not anticipate these costs increasing are now seeing significant margin compression. This is especially problematic for older properties that require extensive upgrades to meet today's stricter risk assessment standards. Fourth, lenders are pulling back from new commercial real estate loans. Many regional banks, once the primary lenders for mid-sized commercial properties, are becoming more cautious. Higher interest rates coupled with concerns over potential defaults are making it harder for investors to secure financing at favorable terms. In some cases, even seasoned investors with strong track records are finding their loan terms become more restrictive, forcing them to bring in more equity or delay acquisitions. Fifth, investor sentiment is shifting towards defensive strategies. Over the last year, we've seen a clear trend where institutional investors are moving capital away from speculative development projects and towards stabilized assets with predictable cash flows. Private capital is becoming more selective, with many investors favoring sectors like industrial and medical offices over traditional retail or even multifamily. This selective deployment of capital signalizes that the smart money is preparing for an extended period of uncertainty in broader real estate market. Now, these 5 factors are interconnected, creating a cycle where market uncertainty fuels hesitation. Hesitation limits transactions, and limited transactions accelerate uncertainty. So investors who recognize these signals early will be in a better position to capitalize when the market inevitably rebalances. To understand the depth of the changes happening in Portsmouth commercial real estate market, we need to look at the numbers. Data from CoStar shows that multifamily vacancy rates have risen to 6.8%, a shift from previous years where demand remained steady. Office vacancies, however, are far worse, now exceeding 15% in certain submarkets. This is a clear sign that landlords are struggling to retain tenants, despite offering aggressive lease incentives. Now, retail properties, for example, especially those outside of high traffic areas, are experiencing a decline in leasing activity. A report from the Federal Reserve Bank of Richmond actually highlights tightening lending conditions across secondary markets like Portsmouth. Loan-to-value LTV ratios are dropping, and commercial loan applications are being scrutinized more than ever. This shift is making it increasingly difficult for investors to acquire properties using traditional financing methods, forcing many to consider alternative funding sources or higher down payments. This consequence of lending slowdown is a noticeable reduction in transaction volume, leading to stagnation in asset pricing. The Hampton Roads Economic Development Alliance has reported consistent job growth in logistics, healthcare, and defense-related industries. These sectors are expected to drive demand for industrial and medical office spaces. However, traditional office buildings and retail centers that don't align with these growth trends are seeing declining lease renewals and longer vacancy periods. The retail sector is particularly vulnerable as e-commerce continues to disrupt brick and mortar establishments, leading to further contraction in demand for large commercial spaces. Meanwhile, institutional investor behavior is shifting. REIT filings and private equity reports indicate that larger investors are reducing exposure to secondary office markets and increasing allocations toward industrial, self-storage, and high-quality multifamily assets. This strategic relocation suggests that well-funded investors are anticipating prolonged softness in certain commercial sectors while positioning themselves for long-term gains in areas areas where strong demand drivers are good. Data from CBRE further supports this, showing that secondary office markets like Portsmouth have experienced a 40% decline in institutional acquisition volume over the past 2 years. Additionally, rising operational costs are exacerbating challenges for property owners. Utility expenses, maintenance fees, and property tax assessments are pushing operating margins down. Property owners who fail to account for these increasing costs may struggle to maintain profitability, leading to more distressed asset sales in the coming months. The data is clear. The Portsmouth market is experiencing a realignment, and those who understand the numbers will be better positioned to make strategic decisions. Most investors think rising interest rates are the biggest challenge, but there's a greater risk lurking beneath the surface: a coming wave of distressed asset sales. Many property owners secured financing under assumptions that no longer hold true. Low interest rates, stable demand, and predictable expenses form the foundation of business plans that are now unraveling. With debt maturities approaching in 24 and 25, we are about to see a surge in forced sales, mainly among smaller operators who lack the capital to refinance at today's higher rates. Compounded by rising operational costs, these owners are running out of viable financing options. Another hidden threat is local government intervention. New zoning regulations, tax reassessments, and stricter environmental compliances measures are adding unexpected costs for property owners. These who fail to account for these regulatory changes could find themselves in financial unviable positions. For example, recent tax hikes in Portsmouth have increased the effective tax burden on commercial properties by 8% over the last 2 years, cutting into landlords' bottom line. Now, additionally, construction costs remain elevated, making it difficult for developments to pencil out. This could lead to long-term supply shortages in key asset classes, which would eventually push rents higher. But in the short term, many projects are simply being delayed or canceled due to financial feasibility concerns. Even well-capitalized developments are pausing projects due to increased uncertainty in material costs and labor availability. Insurance volatility is another overlooked risk. Some coastal markets have seen commercial property insurance premiums rise by over 30%. Now, for properties operating on thin margins, these increases can be the difference between profitability and forced liquidation. Additionally, more insurers are exiting higher risk markets altogether, forcing property owners into limited, more expensive insurance options. And finally, tenant defaults are on the rise. As businesses continue to face inflationary pressures and higher costs, many small to mid-sized tenants are struggling to maintain lease obligations. The rate of commercial evictions and vacancies has been climbing, further destabilizing landlords who are already dealing with rising expenses. Investors who focus on high interest rates are missing the bigger picture. The combination of these factors is creating a perfect storm where undercapitalized property owners are being squeezed from multiple angles, opening the door for opportunistic acquisitions by well-prepped investors. There's one data point that has historically signaled major market downturns, and we just hit it. The difference between cap rates and interest rates compresses too much, market corrections follow. We saw this before the early 1990s real estate downturn, before the dot-com bust, and again leading up to the 2008 financial crisis. In Q4 2024, this spread tightened beyond levels seen in previous corrections, and investors who ignore this warning sign risk significant losses as financing conditions worsen. The danger is that many investors purchase properties assuming that financing would remain cheap indefinitely, and now as debt costs rise, while cap rates have remained relatively flat, owners who overpaid in recent years will find it difficult to refinance without facing major equity losses. And those significant upcoming loan maturities may be forced distresses and sales. Now, the Mortgage Bankers Association estimates that over $1.2 trillion in commercial real estate debt will mature by the end of 2025, meaning a large number of properties may need to be sold at steep discounts. In looking at historical data, these market corrections don't happen overnight. Instead, they play out over 12 to 24 months as investors gradually adjust their pricing expectations. Now, the problem is that once forced selling begins, it can create a domino effect, pushing prices down faster than anticipated. Those waiting for clear confirmation before adjusting their portfolios often find themselves reacting too late. And recent reports indicate that default rates on commercial loans have increased by 20% in the last year, signaling the beginning of distress-driven price corrections. Additionally, corporate bankruptcies have surged, impacting office and retail landlords who depend on long-term lease agreements. These companies, the failure of major national retailers and office tenants is accelerating vacancy rates in many urban and suburban markets. Investors who recognize this pattern early can prepare for both risk and opportunities. Those who ignore these signals may face diminishing returns, even capital loss, as the market adjusts to new realities. The Portsmouth commercial real estate market is on the cusp of a correction. Whether that correction is mild or severe will depend on how investors and property owners react in the coming months. Now is the time to assess portfolios, secure finance, and be ready to act on distressed opportunities that will inevitably emerge. Investors who want to stay ahead of the curve need to act strategically. Here are the 5 moves to consider. Identify undervalued multifamily properties. See, rising vacancy rates have created opportunities to acquire well-located properties and buildings at discounted prices. Investors who focus on value-add strategies can still position themselves and these assets for long-term gains. Look for properties in emerging submarkets where demand fundamentals remain strong, but seller expectations have not yet aligned and adjusted to new market locations. And look for distressed office to residential conversions. With office vacancies remaining high, some properties will inevitably be repurposed. Investors who move early on conversion projects will have an edge in meeting future housing demand. The key is identifying office spaces with floor plans that easily can be adapted to residential layouts while securing zoning approvals in municipalities that support adaptive reuse strategies. Target industrial assets and growing logistics corridors. Portsmouth proximity to shipping routes and transportation infrastructure makes industrial properties a solid long-term bet. Look for opportunities near major distribution hubs. E-commerce growth and supply chain disruptions have increased demand for last-mile distribution centers, making smaller, strategically located warehouses attractive investment opportunities. Secure financing before conditions tighten further. Lending standards are already stricter than previous years, and they could tighten even more. Investors should lock in favorable financing terms before credit availability shrinks. Those who assess private lending sources or creative financing, such as seller financing or assumable loans, may have an advantage as traditional lending channels have become more restrictive. Diversify into medical office or even self-storage. These asset classes have remained resilient in downturns. Investors who shift towards stable cash flow properties will weather the uncertainty better than those focusing on solely traditional office or even retail. Now, medical office demand is being driven by aging population and technological advantages in outcare patient, while self-storage demands remain strong due to lifestyle changes and increased mobility. Monitor distressed sales and pre-foreclosure opportunities. Rising debt costs and insurance premiums are pushing some property owners to be at the brink of financial instability. Investors who track properties with upcoming debt maturities or operational distress can secure assets at below market prices. Establishing relationships with brokers, banks, and loan servicers can help identify distressed properties before they even hit the open market. So evaluate short-term rental opportunities in strategic locations. While traditional hospitality assets are struggling in some areas, demand for short-term rentals remains strong in markets with tourism appeal and transient workforces. Investors who can adapt traditional multifamily properties to accommodate short-term rental models may find increased revenue potential compared to standard long-term leases. Build liquidity and be patient for the right deals. As the market shifts, liquidity will be key to taking advantage of emerging opportunities. Investors who maintain cash reserves and avoid over-leveraging will be in a stronger position to acquire high-quality assets when market conditions stabilize. Timing is everything. Those who wait for perfect conditions will miss opportunities, while those who adapt to market realities will gain a competitive edge. The Portsmouth commercial real estate market is changing fast, and in the next 12 months could define the next decade of opportunities. But there's an even bigger shift coming that will not affect just Portsmouth, but commercial real estate across the country. In our next video, we'll break down how national economic policy changes and upcoming interest rate decisions will reshape the investment landscape. You'll learn what sectors are poised for the biggest gains, how to position yourself ahead of the competition. So if you want to stay ahead, subscribe now, and thanks for watching.